In this video, we are continuing with monetary policy, this time discussing specific monetary policy objectives. The focus will be on inflation rate targeting or inflation targeting, as that is the objective adopted by the majority of central banks. We will, however, we will talk about what is needed in order for that inflation targeting to be successful. Factors like the independence of the central bank, its credibility, transparency in communicating with the markets, how the specific target, inflation target, is set. We will also mention some exceptions to inflation targeting being the primary objective, and also devote quite a lot of attention to the fact that certain central banks or some central banks pursue instead of an objective of not targeting inflation as such, but targeting a certain specific level of their currency's exchange rate versus another currency. Very often that other currency will be the dollar. Okay, so let's start over here with inflation targeting. This is a phenomenon or a concept that became quite popular in the 1990s. It came to the forefront of central bank objectives, and the idea was to try and control inflation, and of course, by virtue of that, maintain price stability. And central bankers and politicians agreed that targeting a specific level of inflation, so it's not just about let's keep inflation under control and let's ensure price stability, but let's aim for a specific inflation target, for example 2%, which is commonly adopted in numerous countries, or around 2%, and also monitoring various economic indicators around that this is the best approach. That was the consensus that begun in the 1990s. Now, the pioneer in this respect was New Zealand, whose then finance minister announced a plan to reduce inflation, which was quite high. It was at 6%, and he wanted. The government wanted inflation to be reduced to a range of 0 to 2%, and in the very late years of the 80s, specifically in 1989, there was a special act adopted which gave this goal sort of legal status and made the Reserve Bank of New Zealand responsible for it. So 1988, obviously I don't expect the year to be tested, but please note that New Zealand was the first in stating a specific target for inflation, and then this came into force legally in 1989 and became the official target for the Reserve Bank of New Zealand. That is that country's central bank. Okay. There are three crucial elements that sort of contribute to the success of a policy based around inflation targeting. They are central bank independence, the central bank's credibility, but also transparency. So let me maybe over here write that these are elements which contribute to success or successful inflation targeting. Okay, and we will be exploring each of these one by one. So let's start with independence. Obviously, when we talk about independence, we mean independence from government, from political influence, the influence of elected politicians. And this separation is quite crucial. It's deemed to be very crucial to prevent, political interference in monetary policy decisions, because ultimately, if you think about politicians and their goal of probably winning the next elections, they try to exert pressure on the central bank, but often that pressure is to reduce interest rates, to make people's lives easier, to make their mortgage loans less expensive, etc. But reducing interest rates isn't necessarily the best idea when you've got high inflation, or if you've got the economy running at maximum capacity, and the thing you should be doing is actually cooling the economy down rather than loosening monetary policy and exacerbating the sort of the bubble in asset prices, for example. So, making the central bank independent of government and therefore of political influence is quite important for inflation targeting to be successful. However, please operate that there are various degrees of this independence, and two key words which appear over here are operational versus target independence. And I want to tell you a little bit about this. So, operational independence is all about deciding on the optimal level of interest rates. Deciding on the level of interest rates. As we talked about in a previous video, interest, I wanted to write interest, not policy, but interest rates. Now I've got this hidden behind something over here. So what I meant was, interest rates. The policy rate, for example, the rate at which the bank lends lends money to commercial banks. However, some banks also enjoy a higher level of independence known as target independence, and that's a deeper concept. Target independence, because it involves not only deciding, the central bank having the flexibility to decide on the actual level of rates, but also on the inflation target itself. What inflation target should we be aiming for, and the horizon, the time horizon to reach that target. So, for example, in the Eurozone, we've got the European Central Bank, the ECB, and the ECB has both operational and target independence. So the ECB, Monetary Policy Council, they set the target inflation level to which they want to get, and they make decisions about how to get there in terms of increasing or reducing interest rates. However, on the other end of the spectrum, you've got the Reserve Bank of New Zealand. As I said, that was the first bank to actually officially go for inflation targeting back in the late 1980s. And they only have operational independence. Also, Bank of England, the Bank of England is also operationally independent only, but not target independent, because in those countries where the central bank doesn't have target independence, the inflation target is sort of dictated by government, and the central bank just has to do what it can to achieve that target. Irrespective of all this, there are certain challenges, let's say, to this idea of independence, because even in the most developed of countries, very often the central bank governor and members of the relevant committee or council are going to be appointed by government officials or by certain, authorities or bodies like Parliament, etc. So they are in some way, they are never 100% independent. There's always a link to politics, which is unfortunate, but that's the way it is. Okay. Now the next point here, in terms of the success factors that contribute to inflation targeting indeed being successful, is this notion of credibility, the central bank being credible. Credibility, that word, basically signifies that market participants, market observers, the population at large, trusting the seriousness of what the central bank does and its commitment to do so. So there's this kind of public confidence that the central bank knows what it's doing and the tools that it uses are going to be ultimately effective, and that is very crucial for effective inflation targeting. And so public confidence in the central bank's commitment. You see, if it was, for example, the government running monetary policy, and the government would say, well, let's target inflation, let's get inflation down, what people might do is actually lack confidence in the government's credibility, because on the one hand, you've got you would have a government targeting inflation, they want to knock it down, but on the other hand, governments typically borrow money and are running on pretty high levels of sort of sovereign or national debt. And actually, inflation as an economic phenomenon has a positive effect on that debt level, because the real value of borrowed money, the debt, goes down the higher the inflation is. You have to give back that old borrowed amount, but under conditions of inflation, the true, real, present value of that debt is going bigger and bigger the more inflation we've got. So the idea here is that the government wouldn't necessarily be credible if it was to fight inflation, because it would have a conflict of interest. The central bank, which is supposed to be independent of government, in theory, there is nothing to stop it from fighting inflation, which should be its number one, and typically is its number one target. So, the belief that a central bank's target can stabilize inflation actually becomes a self-fulfilling prophecy, because when the bank says we're serious about fighting inflation, we're going to do whatever it takes, which is a phrase often used by central bank governors and presidents, especially in recent times when they've been fighting inflation, already builds into people's decisions, and they start acting as if inflation going down is almost a fact. So, but that requires credibility, a certain level of trust. Okay, the next point here is transparency. So transparency, especially in the way you communicate with the market, is very important in establishing and building credibility and, of course, public trust. And the best way to achieve transparency is basically to communicate with the market via something that's going to be systematic, scheduled, and many central banks produce regular so-called inflation reports, okay, and various types of assessments of how well they are doing in terms of fighting inflation or keeping inflation close to the target. This kind of inflation report is often produced quarterly. Obviously, it varies by country, from country to country, and such an inflation report would typically have very specific components. measures of money. So, the supply of money measures, aggregate money measures, credit conditions measures, some overview of financial market conditions, an assessment of what's going on in the real economy, especially, for example, in the labor market, what's happening to prices, so it's what's actually happening to inflation. And it will also have forecasts for inflation, typically medium-term forecasts, and such medium-term forecasts would typically be for something like a 2-year horizon, e.g. 2 years. And in a moment, I'll talk to you about why, the central bank is actually thinking about inflation targeting 2 years ahead, where that 2 years is coming from, or something similar. Because it's now time to divert our attention to the target itself. So we're thinking about inflation targeting. We've talked about the history behind this. What's needed for this kind of targeting to be successful, and now the target level itself. So as I already mentioned, in many developed economies the target is 2% inflation, obviously annualized. It's going to be typically based on the CPI, the Consumer Price Index, as the relevant measure of inflation. However, most central banks do it in such a way that they set themselves a target of 2% or something close to that, and they permit deviations from that target within what is going to effectively be a symmetrical band around, or range around, the target. And the most common one you're going to find is plus or minus 1%. So effectively you get 1% and 3%. And the question is, why 2%? Why, for example, not 0? And I know I didn't make this question up. It is asked in your curriculum. Well, first of all, you don't go for 0% because it would be easy to get the economy into deflation, so negative inflation, a situation of persistent price drops. And that's something to be avoided because I think, as I mentioned in a previous recording, if prices in the economy are falling and and there is an expectation that they will fall, the expectation is enough, people like you and I, so consumers, will perhaps delay our purchasing decisions. If you would like to buy a new piece of electronic equipment, or maybe a new car or something like that, but you don't necessarily need it right here, right now, if you expect the price of that good or that product to drop and be lower in 6 months' time or 1 year's time, you will easily defer and delay your decision by another couple of months, knowing that it will be cheaper in the future. And if we all collectively start thinking like this, we basically stop buying as much as we do right now. We stop investing. We delay decisions, and that leads to, unfortunately, to economic deterioration. People start, companies have less orders, they produce less, people lose jobs, and you get yourself into a stagnating economy, which is tough. Why not go for something higher, like 10% perhaps? Well, at higher levels like that, double-digit figures, inflation just becomes very unstable. And and it's easy to get into what's known as an inflation spiral. I mean, your book doesn't discuss this here, but the inflation spiral is when we all start expecting inflation to be high, we start demanding higher wages from our employers because we expect prices to be higher in the future, so we know we want to earn more. Our employers know that we will come for higher wages, so they hike the prices of goods and services even higher. We know they will do this, so we demand higher wages, and you get into a sort of self-propelling spiral mechanism, which is difficult to fight. It becomes very volatile and unstable. It's very difficult, especially for businesses, to start to continue planning reasonably because they don't know what prices they'll face. So that's why we go for a moderate target, typically of something like 2%, but there is nothing, too scientific about 2%. And now let's come to this focus on future inflation. First of all, let me say that when the central bank looks at inflation conditions, you're looking at CPI figures, but remember that CPI is typically measured for the last 12 months. So you're looking backwards at conditions over the last year, typically. And this is similar to the notion of driving a car whilst trying forward, whilst looking in the back view mirror. You're seeing what happened and trying to make decisions based on this. So obviously the central bank decision makers, the relevant members of the relevant bodies like monetary policy committees or councils, they use a whole host of economic indicators. A lot of them should be forward-looking or leading indicators. Why do we target inflation 2 years ahead? Remember, we talked about this in the previous video, there is something called monetary policy transmission. So if we take certain decisions, for example, concerning the level of interest rates, making them higher and therefore tightening conditions, or lower and therefore creating more sort of loose environment, things will not feed into the economy, or the effect of those decisions will not be felt in the economy immediately. It typically takes time for people to start reacting in a specific way, which is why we target inflation ahead, and that horizon is very often something close to 2 years. Now, this is very, perfect, I think, material for what could hypothetically be a theoretical question. Okay, so let us now discuss just a few exceptions to the general notion that most central banks target inflation. And it's not universally the case. I mean, it is the case in many countries, but not everywhere. And the two notable exceptions, very important ones, are Japan and its Bank of Japan. The Bank of Japan has been fighting deflation for decades now. And they don't have an explicit inflation target as such, because their sort of target is mainly trying to get out of deflation, although many people think that if they did have an explicit inflation target, that could help pull the country out of deflation. And the even more important, I think, example is the US Federal Reserve. The Fed doesn't have a formal inflation target. You will not find it. And that's because when you look at the objectives of the Fed, there is inflation or stable prices are absolutely not the main objective, as is often the case. The Fed actually has 3 objectives, and they try to achieve a balance between them, and that's maximum employment, stable prices, and moderate long-term interest rates. And I think, and the idea is, if you put in a specific inflation target and communicated it, that could undermine in people's eyes the perception that these 3 are all equal. So instead of having an explicit target, they prefer not to, just to maintain some kind of balance. And now, just a few words about the fact that whilst monetary policy is, well, it's not easy, but it's something that probably works quite well in developed countries. Developing nations, in terms of operating monetary policy, face a much bigger challenge. And you should be aware of some of the impediments or some of the reasons why trying to run monetary policy in developing nations, developing countries can be challenging. First of all, a lot of the monetary policy tools, or a lot of the work of central banks, isn't just about setting interest rates, but also about conducting open market operations, which is the buying and selling of bonds. Well, often developing nations don't have a liquid government bond market, which is an impediment, and they don't really have sometimes an interbank market. An interbank market is where banks borrow money from one another, and very often the first place where you see monetary policy decisions transmitting to the economy is via the interbank market. So if you don't have that, it's going to be more difficult for monetary policy to be effective. They've got, conditions which often change very, very abruptly. Economic conditions, political conditions, which complicates policy setting. Obviously, the lack of stability always complicates achieving a certain, predefined goal, especially when it takes a long time to get there, or a prolonged time to get there. There's a lot of innovation happening in these developing economies. People using financial channels which are not necessarily the traditional ones, and that also makes managing, especially money supply, very difficult. Often those countries will have a poor track record on inflation, meaning they previously run at very high inflation levels, and people just don't trust that the central bank can manage the situation, so lack of credibility. And when the central bank is perceived not to be credible, then the announcements of the central bank, their goals, will not really be thought of as something to take into account. And also, very often the central bank doesn't enjoy true independence, because governments in many developing nations, but not just in developing nations, also in some developed countries, are really unwilling to grant the central bank proper, true independent mandates to run monetary policy. Now, we're going to finish off with this notion of exchange rate targeting, because this is especially true for developing nations. So many developing countries opt for exchange rate targeting instead of inflation targeting. So this is, you could say, it's an alternative to the more prevalent model of inflation targeting, exchange rate targeting. Right, how does this work? The central bank sets a fixed level, or perhaps a band, so a corridor, for the exchange rate of that domestic currency against a major currency. So very often you try to keep a stable exchange rate against, for example, the US dollar being the world's sort of most dominant developed currency. And what the central bank tries to do in order to maintain that fixed level, or the exchange rate within that corridor, is operate in the markets, in the currency markets. So what the central bank will do is buy or sell the domestic currency accordingly, to make sure that it is trading within a certain band relative to a more stable, more developed currency. And this is often associated with the notion of importing the inflation of another economy, like the US, for example, but importing the inflation of another economy. So what I want to do now is show you how this works in practice. So we'll talk about this buying and selling of the domestic currency, what the central bank actually does. So let me go here to a different page. Let me make this occupy the whole screen. Good. Easier to write than just a page without any grids. Okay, let's imagine that we've got a domestic currency over here, and this is the US dollar against which we are going to try and fix our exchange rate. So how would this work in practice? First of all, the central bank, or the government, announces the exchange rate, and that exchange rate should hold, ideally, this should hold and be in place, but only if a very specific condition is met. If the inflation rate in that domestic currency equals the inflation rate in the US dollar, assuming it is the US dollar that we have chosen to target, or the exchange rate against the dollar that we have chosen to target. If the two inflation rates in the two countries are the same, the exchange rate should hold as well. However, what if it doesn't work? Or if the inflation in the domestic currency is actually higher than the inflation in the US dollar? What if this is the case, which it often is? Then there will be, very, let's say, straightforward effects happening in the market. And let's just say why the domestic currency's inflation rate could be higher than the USD's. This could, e.g., for example, be due to faster rate of growth. In an economy that is moving faster, developing faster, inflation will typically be higher, resources are becoming scarce, etc., right? And the domestic currency, due to it having a higher inflation rate, will actually go down. It will depreciate against the USD, against the dollar, purely for the reason that it has a high inflation rate. So the value of that domestic currency is eroding quicker over time than the USD. Now, many people think, but the economy is growing faster here. Okay, that's not as important. Inflation is going to be the big driver here. The relative value of something subjected to high inflation will fall against the currencies of lower inflation economies. Now, if the domestic currency is depreciating against the dollar, we are deviating from the chosen target exchange rate. Right here, it announces the exchange rate, the target, and it's not holding because the domestic currency is depreciating. So the central bank intervenes. It now needs to lift the domestic currency up against the dollar. So what it will do is they buy the domestic currency in the markets and simultaneously sell the US dollar, because in order to buy the domestic currency in the currency market, you have to also be selling something else, naturally the US dollar. And by the way, in order to perform this, you need to have USD reserves in the first place, right? so that you can actually do this, or borrow USD from somebody like the IMF to be able to do this. Now, as a result of buying up the domestic currency, you obviously push up the value in the market accordingly by buying something up, by generating demand for it. You lift its value, so I guess you hold the decline, at least temporarily. But there is also a sort of deeper macroeconomic effect as well. By buying up domestic currency, you decrease the money supply in the economy. There is less money in the economy because it's been bought up by the central bank. And as a result, interest rates in the markets go up. Okay? Interest rates go up. This is, classic monetary policy becoming tighter. And if monetary policy becomes tighter, obviously inflation should go down, and you kind of resolve the problem which started with your inflation in the domestic currency being higher than that of the country whose currency you are targeting. Now, if the reverse is true, if inflation in the domestic currency is actually lower than inflation in the US dollar, then what the central bank will do is the reverse. But let's go step by step. The domestic currency will actually appreciate in the market against the USD. Okay, which is obviously the opposite thing to what we had before, when inflation in the domestic currency was higher than that in the US dollar. The domestic currency was depreciating against the dollar. Now it appreciates against the dollar. So once again, we are moving away from the target exchange rate, which was announced and set by the central bank, and the central bank will once again intervene. This time it will sell, so it sells the domestic currency and buys the USD, and by buying the USD you increase your foreign reserves at the central bank, but selling the domestic currency into the market increases money supply. Increasing money supply leads to a lower rate of interest. Interest rates go down, and typically by that means you stoke a bit of inflation, right? Because monetary policy becomes cheaper, looser, things become cheaper, so that's a sign of so-called expansionary policy. As you can see, as a result of targeting the exchange rate, typically of a more developed economy like the American ones, via targeting the US dollar, you essentially also target that country's inflation. And by trying to keep your exchange rate in line with relatively constant against the dollar, you also have to increase and decrease money supply and interest rates so as to have the same level of inflation as the USD, or as the Americans in this case. And this is basically what I meant when somewhere over here I wrote down that the effect of this is to import the inflation of another economy, most notably the US. Let me just go back and say one or two things here. about this policy of targeting, exchange rate targeting. It requires constant potential reaction, right? Because even if you set yourself a target and you try to keep the exchange rate within a certain band, right, around the target, you will from time to time have to intervene. And this unfortunately causes a lot of volatility in your own domestic money supply, because money supply is either increasing, when it goes the other way, it's decreasing as a result of you buying and selling the domestic currency in the open market. And in line with that volatility of money supply going up and down, you also have volatility in the exchange, not in the exchange rate, but volatility in interest rates, domestic interest rates. So, you know, that's the side effect, a lot of volatility, potentially. Right. I just wanted to mention one sort of last phrase here. Instead of inflation rate targeting, some countries have opted for what is known as dollarization. And dollarization means replacing your domestic currency, of course, with the US dollar. Okay. And this has been the case, as your book notes, in places like Panama or Ecuador. Relatively, you know, not the biggest countries in the world, especially Panama. That's a different level. You know, that's not even trying to keep an exchange rate, but replacing your own currency with somebody else's.